Welcome back, investors, to Ticker Time News. I'm Adam. In today's trade, well, it was mostly a negative disposition. The major indices opened to losses before tumbling further still. Strength from some of the mega cap stocks did fuel a rebound effort around midday before the market lost steam again. The S&P 500 eventually fell below Friday's low of 38.38. But that's where buyers returned and helped the indices pare some of their losses into the close. On the chart, we've got the SPX for the S&P 500. I'm going to go to the 15-minute time frame just to show you the past 3 trading sessions, and you can see some similarities. Number one, my highlighter here, we've got this low right here, right here, right here, and again, kind of cutting through right here just slightly, all somewhere around 38.38 as the low on the S&P 500. Now on the SPY, that would be about 383. Okay, we got that. There seems to be support stepping in at these prices. But we've got stiff resistance, not even up to the 3,900 like we reached here yesterday, but even lower, right around, let's call it 38.75. There's resistance there already. And if what comes out of the Fed tomorrow is, well, the probability is an 83% that we will see a 75 basis point rate hike. There's still a very tiny 17% probability of a full 1% move. Now, I don't think we're going to see that. That would be a huge stomping the foot down by the Fed, but I don't think that's going to happen. I feel pretty confident we're going to get that 75 basis point rate hike, and the market has priced that in. What the market has not priced in is, and I've said this all week, I'm sorry if it's getting boring. You've heard it multiple times before. Jerome Powell, if he comes out and he says something more hawkish than consumers and businesses alike expect pain so we can get inflation under control. If it's any more hawkish than what I just said, the market will sink. However, if Jerome Powell comes out and he only reiterates what he said right here at Jackson Hole, which caused the S&P 500 to drop 3.4%, then the market will be fine. Everything is pinned to Jackson Hole. So that's what we have to watch out for. And the biggest sentiment that I could pick up from Jackson Hole is what I just said about the pain. Consumers and businesses expect pain because we must get inflation under control. Anything more hawkish than that statement right there is what will cause markets to dip, drop, fall, crash, whatever word you want to use. Otherwise, if it's just a repeat, the market is set to rally. If it is just a repeat of, we've got to get tough on this, we've got to get inflation under control, we're going to keep raising rates, we're going to keep doing quantitative tightening, which is taking liquidity out of the market. I mean, $95 billion per month just started in September, and they're going to do that for several months. What do you think happens to a market that's losing $95 billion of liquidity? It definitely does not help fund a massive rally, a massive bull run like we saw over the past 14 years. We're not going to get this massive bull rally, bull run, bull market if the Fed is still doing QT and raising rates into a slowing economy. It just mathematically, it can't happen. So everyone's waiting for Jerome Powell to say Fed pivot, and then maybe then the market can start to ease a bit, climb back up, get some solid footing, base out, and then climb. So my expectation for tomorrow is somewhere between middle of the road to slightly more hawkish. That's what I'm thinking. What are you thinking? Do you think Jerome Powell is going to come out and be more hawkish, be more stern than he was at Jackson Hole? Do you think he'll remain the same and basically just repeat himself like he did last week? Or do you think he's going to come out and say, well, we need to let our foot off the accelerator a little bit. We might be pushing ourselves too hard, and this old race car might just break. Not quite a pivot, but a slowdown. Maybe. I don't see that yet. Maybe next month. Well, technically in November, because there is no FOMC meeting in October. I was just about to ask how far the same old news rally can take us. Okay. If Fed Chair Powell comes out nothing worse than Jackson Hole, right? Nothing worse than saying pain for the consumer, pain for the businesses, because we have to fight inflation. I think if he doesn't say anything worse than that, I think it is very easy for this market to gap back up, run up to the 4,000 level mark for the S&P 500. That would be 400 for the SPY. And right now, for the S&P 500 and for the SPY, there is a speed bump at 3,900 for SPX, 390 for the SPY. That would be the next real test to anything less hawkish than Jackson Hole, to see if the momentum in this market can lift us past that. I think it can. If Jerome Powell is just same old news, I think we do have enough momentum in the market to get past that 390 on the SPY, 3,900 for the SPX. And if you remember yesterday, we got to a high of 3,900 and that was it. There was a ceiling there. We saw it on the 15-minute chart. Yesterday's close was at 38.99, literally 1 point off of 3,900. So that'll be the first test of the momentum if Jerome Powell is news as usual, what we've already heard. And I think there's enough momentum to get past that, go to 4,000, find some pressure at 4,000. But I think if everything is positive before more company-related bad news, if everything stayed rosy for at least a solid week, I think we could get to 41.20. I think that's a realistic number if everything remains positive. But I got to put a little caveat there. Look what Ford just did today. Well, Monday after the close. Look what FedEx did last week. Big warnings, especially the FedEx warning. That one's got more weight than the Ford warning, because FedEx literally has its finger on the pulse of the global economy. And if FedEx says things are slowing down, then you better believe they are. That type of bad news can wreck any rally, can stop it in its tracks. So while I think 4120, and that would be 412 on the SPY, I think that could be a target in rally mode. We have to have everything line up, the stars align, to get that type of a rally. Because we are under a very, very difficult situation. This next earnings season coming up, we may actually start to see earnings being revised down. Just like FedEx, just like Ford. And that will stop any rally in its tracks. Now, the technical picture, why I think we could probably slingshot to 3,900 real easy, is because we were there yesterday. RSI is at a 35. 5 points from being oversold. So things are set up for a rally if everything tomorrow is peachy clean and everyone is just fine. If not, though, if Jerome Powell comes out, I see your comment there, and does a 50 basis point rate hike, which I highly doubt, that would surprise everyone. And the markets, they do not like surprises. Whether a good surprise or a bad surprise, the market likes consistency and it likes to know what's going on. If it's a surprise on the positive side of things, well, then slingshot that rubber band, the market's going. A 50 basis point rate hike tomorrow would do that. Now, I don't think that's happening. Just like a negative surprise sends the market down. Ford, FedEx, two prime examples of negative news recently that shakes the market. Now, the biggest factor pressuring investor sentiment today was rising Treasury yields. Let's look at that 2-year yield. US 02Y on TradingView. The 2-year yield overnight reached 3.99%, nearly 4% on the 2-year yield. This thing is going like a rocket. Boosters and everything. Let's see here. Let me put the cursor on it. 3.992 was the high for the 2-year. Now, it's settled at 3.97, and that's exactly where it sits right now in after hours. This rocket ship, and I've said this multiple times, you guys probably get tired of hearing me saying the same thing over and over again, but I never know who's catching us for the first time. And I want to make sure that everyone is dialed in here. The 2-year is most sensitive to the Fed funds rate. So when the Fed hikes that interest rate, the 2-year will go up. The 10-year, let's look at that. US 10Y on TradingView. There is a link in the description to sign up for a free account to TradingView. If you haven't already, you can do all your charting there too, just like us. Look at the 10-year, following that trend line perfectly. The 10-year, it reached 3.6% overnight. It settled at 3.56% at the close today. It's about to get to maybe a 3.57%. It's getting close. It's up just slightly in the after hours. But this thing's like a rocket ship too. Now, the 10-year, when it races up, that puts pressure on the Qs, on technology, on the NASDAQ, and the 10-year is most sensitive to growth concerns. Hello, Ford, hello, FedEx, and the economy. The economy's slowing down. Growth concerns, inflation, that's what the 10-year is tuned into. So this thing ratcheting up to a multi-year high isn't helping the narrative of peak inflation. The 10-year rising like this, hitting multi-year highs, highest since at least 2011, over a decade ago. That's not good for the narrative that, oh, the economy, it'll bounce back quick. It's not going to be very bad. Or the changing of definitions to fit your narrative about whether we're in a recession or not. Now, in today's market, there were a few other additional factors that were piling onto higher rates. So it wasn't just that the Treasury market was expanding, but there was also some worrisome inflation data from Germany and Japan. That affects more of the global market and multinational companies. Think of Apple, right? If Germany and Japan are having problems with inflation, I mean, right now, I know we focus on the US here, but this really is a global problem. Inflation is a global problem. It's not just a US problem. It's a global problem. And that's going to hurt multinational companies like Apple. Even though you wouldn't think of it, Apple had a great day today. And then the thing I'm going to dig into here a little bit deeper is the other black hole on the market or in the market that just had everybody whirling around, and that's Ford. A Q3 earnings warning from Ford. Let's pull up that ticker, which is just the letter F. They were down over 12% today. Might not think that's a big number, 12%. For Ford, it is. Ford doesn't typically see it. And the volume in which Ford dropped, that was significant. I mean, Ford's a $13 stock. It is catching a bid here in the after hours. It was up slightly, like 0.5%, yet 0.6% in the after hours. So it is catching a bid here. People trying to get in thinking they're getting a good bargain. But if we go into a real troubling recession in 2023, not just, what we're talking about here in 22, but if 2023 we get into a deep recession, those who are catching the bid right now, they're going to be on the losing side of that trade for a while. The last time we looked at Ford, we thought it was building a base back here. You can see the green highlighter still there. Now, Ford, this, of course, comes after and FedEx. I keep saying Ford and FedEx because those are the two big warnings. But Ford's warning, of course, comes after FedEx's own earning warnings from last week. And I've said this before many times, and I'll continue to say it. Expect more of these warnings as our slowing economy continues to slow. These will provide serious pressure to earnings. This slowing economy will provide serious pressure to earnings. Now, Ford's warning, it was attributed to higher than expected supplier costs and incomplete vehicles amid the chip and other parts shortages. Ford has got trucks sitting, can't ship them because they're missing parts, but Ford does expect to get at least a significant amount of supplies that Ford believes it can make up for some of this shortage in Q4. So Ford at least did leave a little light shining for hope that Q4 could be an okay quarter. I just want to put that out there. It's not all doom and gloom. Now, Ford expects a $1 billion more. Expects $1 billion more in supply costs than it had forecasted. $1 billion more. Now that $1 billion, it's got to come from somewhere. Now this is due to inflation in its input prices. And if Ford is seeing $1 billion more in supply costs, those vehicles that consumers are buying from Ford will increase, because Ford's got to make that $1 billion up somewhere. And I don't think it's going to be from selling electric vehicles. Now, with Ford's problem here, many other companies are facing the exact same problems. Many analysts have been saying that inflation, that supply chains have been easing. They've been getting better over the past several months. But what Ford is saying here is, no, sir. The supply chain is still being disrupted. And this is going to cause pressure on earnings for all kinds of different companies and all kinds of different sectors. Now, I did share with our investor community before we went live our top 10 momentum stocks this week. In that note, we also shared a couple of sectors that, if we do get a bounce, could see the most benefit from that bounce. So if you haven't checked that out yet, make sure you do. Just want to throw that in there while it was on my mind. All right, let's get back to the markets here. There was also and I can't forget to mention this. There was an element of caution ahead of tomorrow's FOMC interest rate decision. The release of the updated summary of economic projections. We get that each quarter. The last time we got it was in June. We get that this meeting. That'll help us to better understand not just Jerome Powell and his thinking, but the other Fed members as well. Don't want to miss any of your... it was about time Ford corrected. Yeah, it was. They were on a pretty good run. All the talk about EVs, it was good for Ford. It was. Okay, summary of economic projections. That'll help us have a better clue of what the overall, all the other Fed presidents, what they're thinking, where they think the interest rate will be by the end of this year, maybe even into 2023. I'm thinking 4% or higher. That would mean 75 basis point rate hike tomorrow, and then two 50s, a 50 basis point rate hike in November, a 50 basis point rate hike in December. That would get us over 4%. And then, of course, the biggest wild card tomorrow is Fed Chair Powell's press conference. Now, the press release with the interest rate hike decision and a few extra notes, that'll come out at 2 p.m. Eastern. 2:30 p.m. Eastern, that's when Jerome Powell, he'll give his press conference. That'll be the most critical time tomorrow in the markets. And it's why tomorrow morning I'm doing nothing in the market. I will be waiting until Fed Chair Powell is speaking, because what he says will determine the direction of this market. And what comes out tomorrow from the Fed, it'll set monetary policy for the rest of 2022, from now to December. So if the Fed is going to continue to be hawkish and be aggressive, we'll know tomorrow if it's going all the way through the rest of this year, or if they're going to slow down at some point. What they're looking for to be able to slow down. But the quantitative tightening, that's not going to slow down. That's going to keep going. 95 billion each month. Yeah, I'm not doing anything till the market decides what to do. That is a good plan for tomorrow. Absolutely. Because you could get your face ripped off by a bear claw if you're not prepared for that, or by a whiplash of the rockets taken off to the moon if you're not prepared for that side of the trade either. And the market could literally start rallying, and then Fed Chair Powell says something that the market doesn't like, and then boom, it can come right back down. I mean, that's what it did last time around. Very volatile tomorrow, so expect that volatility meter to crank up tomorrow. It's going to be crazy. Now, in today's market, support from mega cap stocks drove the midday rebound attempt, particularly support from Apple. AAPL is the ticker for Apple. Now, Apple was up 1.6% today. Real nice move. And it was up yesterday. Another nice move. If we look here, I do have the updated weekly expected moves for Apple. And you'll notice something. Apple today, its wick broke through the upper end of the weekly expected move, but then closed right there under the line. So the weekly expected move is 157 on the upside, 144 on the downside. Apple closed today at 156.9. In the after hours, it's up a few pennies, maybe about 12 cents, and it's at the 157. So it's just right there on that line. Now, could Apple go higher? Yes. What we have to watch out for Apple, if we do catch a bid tomorrow, I'm not sure about that. Like I said at the very beginning, I'm sitting kind of in the middle, unsure. It's hard to predict what one man is going to say. But I'm also leaning a little bit towards the downside. Today, I got it wrong. Remember yesterday's live stream? I was leaning that today we could see a little rebound, at least up to that 5-day EMA, right? Well, for Apple, it pulled past that 5-day EMA today and closed right on the upper end of the weekly expected move. Now, Apple is still under its 200-day, its 50-day, its 20-day moving averages. Those are all important. Can it break through that 50-day? It's possible, but that would take something pretty substantial for Apple to do that. Now, Apple had some good news today, which helped. Apple rallied after announcing that it's going to increase App Store prices in Europe and Asia next month. Do you think Apple is struggling with margin compression if it's announcing that it's going to raise its App Store prices in Europe and Asia? I think it is. Is that good? Or is that inflation? See, investors took this as a good sign. Apple is raising its prices. But Apple is already pretty expensive as a brand. So, I don't know. I don't know if that's a good thing or a bad thing. Now, its rally today did come on lighter volume. Still above average, but lighter volume, I will add. It looks like simple math, 8+% inflation, increased interest rates close to 6%, so it reaches 2%. Okay, that's interesting. That is definitely interesting. Yeah, mortgage rates have crossed that 6%. It's incredible. This is definitely a very fast rate hike cycle. Okay, still though, Apple considered mega cap growth stocks. They didn't do so well. Apple and Alphabet, they did pretty well today. Those were, two of the biggest names that helped to move this market, at least helped to try to establish a bid this afternoon. Get the markets trying to rally again. It just didn't work into the close. Still, though, the support of the mega cap stocks, I guess what I'm trying to say, it wasn't universal. The Vanguard Mega Cap Growth ETF, ticker symbol is MGK, it lost about 0.9% today. And you compare that to the 1.1% loss in the S&P 500. Or even, I believe it's a 1.6% loss in the S&P 500 equal weight ETF. So a 0.9% loss compared to a 1.1% loss, not that bad. But if the mega cap stocks are going to carry the markets into the green today, you would definitely need to see this thing popping above its 5-day EMA, which it has been trading under for several sessions now. Since it broke back into its trading range, it has been trading under its 5-day EMA, the most frequently tagged moving average. And yeah, I know it's a 5-day, so yeah, it is a short one. But it is the trend setter moving average. Short-term time frame, that is. Now, selling efforts today, they were broad in nature, bringing down many stocks across the market. Every S&P 500 sector closed in the red today. Let's pull up the sectors here. And then I want to lower this down just a little bit so we can see the dollar there. The dollar was up today, back up to 110. It's still at 110. And semiconductors, they were down 1.3, 1.4% today. So looking here, right hand of your screen, all those red numbers, that's the 11 S&P 500 sectors plus the dollar and the semiconductor ETF on the very bottom there. So the spread here, it looks like losses ranged from 0.5% technology, XLK, all the way up to 2.6%. Is that really where it's at? Yeah, 2.63%. for real estate, XLRE. So that's a pretty big range. And that 0.5% or 0.6% there for technology, that was pretty decent because the mega caps, and there's a lot of mega caps in technology, mega cap growth, it caught that bid in the afternoon and tried to help with a rally. Now, one bright spot in the market was casino stocks. Surprising. They traded against the grain today after a report indicated that China is aiming to ease foreign entry requirements for tourists. Yeah, China's economy isn't doing so hot either. And they're looking to do whatever they can to relax their requirements to get people to come into the country and spend some money. One of the biggest winners in the casino hotel space today, resorts, was Wynn Resorts, ticker symbol WYNN, up 2.9% today. I think 2.9% is pretty good when it was a red day, but it was a winning standout of the group. So just want to give a shout out to Wynn Resorts there. They've actually been doing fairly well. They are actually approaching their 200-day moving average. They're above their 50-day moving average. I mean, 1, 2, 3, 4 real nice sessions in a row. So that's good. But it is at an interesting resistance point here. There's a lot of supply right here at this $68, $69 a share area. So I probably won't go too much higher there in the short term. Probably see a pullback here. Now, let's talk about oil. US OIL, US oil. Easy ticker to remember. Now, WTI crude oil futures fell 1.1% today to $84.05 a barrel at the close. It's down another $1 in the after hours. Down to 84.04. $1.01. However, this area, I might have to move the green bar down some. We seem to be getting in this area right here some sort of support in the oil market. Somewhere around, I guess we could probably say $80 as the floor, up to like the $85 area. That's been the bid so far and the spread on that bid. Now, it's under a declining 5-day EMA, so that's not good in the short term for oil. If we look here on the 15-minute chart, you can see a big pullback right here. This was right at the open today, 9 o'clock this morning. And then by 10 o'clock, it was done. And it was rallying from that point. Okay. Natural gas, it also fell 1.3%. They've kind of been moving in somewhat opposite directions of late. I've kind of noticed that. All right. On today's economic calendar, it was real limited. We had August housing starts and building permits report. Housing starts totaled 1.575 million units, beating the expectation of 1.448 million units. That was a good thing. Building permits, though, was not. Building permits came in at 1.517 million, undercutting expectations of 1.61 million. Now, here's the takeaway on housing. The weakness in the permits data suggests the strength in starts is not sustainable. especially when you also take into account that mortgage rates have risen since the July-August period. And yesterday's NAHB housing market index for September showed yet another decline in home builder sentiment. It was under 50. That means contraction. This doesn't look good for the home or housing market. Now, I have to admit the housing market hasn't come down as much as I had expected it to by this point. It's actually being pretty resilient and holding up, even though it has, I admit, it has come down. Just not as quickly as I thought it would. But I don't think that's going to continue. I don't think it can compete and keep up this resilience once we start to see labor reports really weakening. And if the Fed is going to continue to be hawkish and continue to press forward with QT and continue to press forward with raising rates, it will cause unemployment to tick up. There's no doubt about it. The Fed is trying to slow the market, or I should say the economy, down. But the economy is already slowing down. And another thing that we have to remember is that what the Fed does today, it could take 6 months or even a year for it to start taking effect, to actually see the fruit of that labor. All right, looking ahead to Wednesday, tomorrow, market participants will receive the MBA mortgage application index. It was at a negative 1.2% tomorrow. I expect it to still be a negative number. That comes out at 7 o'clock in the morning. We get the August existing home sales. Expectation is 4.7 million units, which is lower than last month's reading of 4.81 million units. That's at 10 o'clock Eastern. And then the big mark on the calendar tomorrow, the FOMC interest rate decision. It comes out at 2 o'clock p.m. Eastern, followed by Fed Chair Powell's press conference at 2:30 p.m. Eastern. That will set this market on fire, either on fire for a good thing or on fire for a bad thing. It's either going to be a dumpster fire or a fireworks fire. I don't know what. I don't know a good fire comparison that's positive besides fireworks. All right. So what could we realistically expect the markets to do tomorrow? Good news or bad news? Well, let's go look at SPX. Good news, I think we quickly test 3,900. And if it's really good news, then we could bounce over 3,900. Right now, the 5-day EMA is at 38.98. So that's going to help provide some pressure at the 3,900 level. I mean, we're at 38.55 right now. Getting the 3,900 is not that far away, right? It's not that hard to see us reach it. We got there yesterday. So 3,900, that'll be a little place where there's going to be some resistance. But if the Fed news isn't all that bad, then we could hop right over 3,900 and push our way to 4,000. Maybe not tomorrow going all the way to 4,000, but if it's good news tomorrow, we've got the rest of the week to push ourselves up to 4,000. There, I think there's resistance, okay? The upper end of the weekly expected move for SPX is 39.90. So again, That would put us right outside the weekly expected move if we had good news tomorrow. For the SPY, same thing, okay? The 5-day EMA is at 388, just a couple bucks from that 390. We push through 390, and then we push our way to 400. Now, the upper end of the weekly expected move is at 397, so just a few bucks away from that 400 mark. I think if it's good news tomorrow, we work our way right up to that level. Now, if it's bad news on the SPY, then it depends on how bad, right? The bottom end of the weekly expected move is 373, right? But we were catching this support at about the 380 level. How strong is that support? And you can see if we go back through the middle section right here, that's right at that 380 support area. And there was support, there was resistance, there's a lot of action around 380. So that's why that's been holding up as a decent area of support over the past 3 sessions. Now, if we break that 380 because it's horrible news, and I think it's easy to do, we have a gap to fill right here. And, that's going to take us down to the 378 area. And really, if we get down that far, watch out for testing that June low. The intraday low was 364. We could go retest that over the next couple of weeks if the Fed gives us bad news tomorrow, if the Fed is extra hawkish. Now, looking at the Qs, let me just clean these 2 marks up here real quick. Gone. All right, let's load up the Qs and see what we're talking about here as far as possible moves, good news versus bad news. Now, on the good news side of the trade, we have 300 as the target. The 5-day EMA is at 291. And as I pull this up, you can see we closed at 288 today on the QQQ. And again, 291 is that 5-day EMA. That's the first bump in the road at 290. We break above that. We work our way to 300. I think that's where we could get by the end of the week if it's positive news. Now, if it's negative news, well, we really filled in this gap here yesterday, so I should have taken it off like that. The bottom end of the weekly expected move is 278. And there's a gap right under that. We break below that. We fall through that gap. We go test the June 16 low, 269. Now, how about for the IWM, which is the small caps? Similar story that we've been telling here with everything else. The weekly expected move on the upper end is 185. Now, the 5-day EMA is at 180. That's been a sticky spot. We break above that 180. We can run up to 185. That gap there also got filled. I forgot to take off. Let's take that gap off. Now, if it's bad news, well, then, one other thing to point out too. The reason why I think the 185 would be a real sticky area is that's where the 50-day moving average is at 185. So that's going to add extra stickiness to try to pass through. Now, on the bad news side, we got 172 as the weekly expected move. We break that, we've got a couple gaps to fill, and then we're at the June 16 low, testing that again at 162. So those are the ranges and the numbers to be aware of for those indices. And if you're curious about the Dow Jones, ticker symbol DIA, is an ETF that tracks the Dow Jones. So just load here for a moment. All right, this gap is done and over with as well. So the upper end is 316, the lower end is 299. If we break to the upside, we've got the 5-day EMA at 309. That'll be the first test of resistance because it is declining. Just like on all the other indices, the 5-day EMA is declining, which gives it a bearish bias. Breaking above that, then maybe we can start climbing to the 316 mark, which is the upper end of the weekly expected move. Now, on the lower end, 299, we've got a gap that starts just above that at 301. We fall through that gap, and we are testing the June 16 low of 298. So that's what the Dow Jones looks like too. All right, ladies and gentlemen, that has concluded all the notes here for today. If you have any questions, plug them in now. It's a great time to do so. And if you could, please do me a favor, click that like button, share this video with a friend. That really helps out the channel. If it's your first time watching, consider clicking subscribe. And if you want more of this perspective, click the first link in the description. You get our weekly expected moves. We're working on daily expected moves. That's in a experimental phase right now. It really helps for managing risk. You also have numerous trade setups throughout the week. Top 10 stocks list. We just went and sent out our top 10 momentum stocks for this week. And there's some good names on there. And also shared some notes with the momentum stock list this week to provide some sectors and some names within those sectors that if we do catch a bid tomorrow, if we catch a rally, those are some names in specific sectors that could take off and provide the biggest reward, the biggest return for any potential rally that we may find ourselves in. So it's a really good update this week. I wanted to make it extra special just in case the Fed is positive tomorrow. Wanted to be prepared. If it's negative, you don't have to know much. Just, short. SQQQ is a good one for technology. This is the ProShares Ultra Pro Short QQQ. That's a decent one. If you want to do it for the SPX, the S&P 500, SPXS is the ticker, and that's the direction. Let that load. These short end are leverage. So this is the direction daily S&P 500 bear 3x. So if the market drops by 1%, this drops by 3%. So just a couple of two shorting ideas that are super simple. You don't have to worry and fuss with learning options. You can use these, still use leverage, and it's as clean as placing a trade, getting in and getting out. So I want to point those out. I use them regularly, especially in 2022 when there's been a lot of shorting opportunities. Sometimes you just want to get in and out real quick on a day or swing trade and not mess with options. That's a good way to do it. And It's just like buying a share of an ETF. You can even do fractional shares if you want. So, yeah, just want to point those two out in case we get a sell-off tomorrow. You can at least join in with those two options for you. All right. Well, we'll wrap it up here. Thank you, ladies and gentlemen. I hope we all make it out in one piece tomorrow. And, of course, I'll be back here tomorrow after the market has closed to go over what happened, why it happened, and what to expect. And for our investor community, you'll see me, or you'll hear from me tomorrow. Of course, you'll get my thoughts on the FOMC when that happens, and yeah, so we'll do it all again tomorrow. Just double checking. All right, we're good then. Well, everyone have a restful night's sleep, because tomorrow will and could be a crazy day in the market. So be prepared, be patient, be safe. Don't rush. The best advice is to use patience. Wait for the market to make a decision. Don't get caught up in the chop and the swings and the sways. Once there's a defined direction, hit the floor running. Once you feel comfortable, manage your risk. Keep it good. All right. I'll see you guys back here tomorrow after the market's closed. Have a good one.